afternoon. This is when you are standing between people and their coffees. If you do a panel at 6 p.m., you're standing between them and their cocktails. So, we're going to have to make this feel a little more energetic to get more involvement, because Badr has flown in from Saudi Arabia, and he was just telling me his jet lag has just started to kick in. So maybe what we can do as a starting point, and I'll ask our panelists to give a brief introduction of themselves, and also a little bit about what their job is, what they do. And then we can start a conversation around how they're thinking about the world and where they think about deploying capital, if they are. So maybe, Badr, we'll start from you before you go to sleep.
Sure. So, hi, everyone. I'm Badr Almana. I'm the Deputy CIO and Head of Direct Investments at Sanabil. Sanabil is the venture growth investment arm of the Public Investment Fund of Saudi Arabia, the Sovereign Wealth Fund. And really what we do is venture in and out, right? We invest globally, a lot of focus on the US, given it's the largest market. We invest both in funds and directly, which really is what I focus on mostly on the direct side, which means we invest in companies and in their cap table. I've been in Sanabil for about 10 years now. I've probably done everything there. I've done real estate investments, I've done PE, picked up VC, I think 5 or 6 years ago. And it's been an exciting journey. Really happy here to share with you what we do when it comes to capital allocation.
And I will say, as partners for us in Might March Capital, they've been fantastic to work with, and they are investors in the fund, and we've done quite a few investments together. So he's an easy guy for me to talk to. Stephen.
Yeah, Stephen Williams. I'm with TIF Investment Management. We are a investment firm that serves the nonprofit community, primarily in the US. We manage about $8 billion of total capital on behalf of over 500 different endowed charities. I specifically focus on private markets, and so we have a pretty broad mandate within private markets. Our goal is to leverage the illiquidity of private markets to generate the best returns possible. And so we can really invest in almost anything that we like within a private structure, but where we really focus our time and efforts, and where I really focus my time and efforts, is on partnering with early stage venture capital firms and then doing fund investments as well as direct investments into lower middle market private equity companies, primarily in the US. And so we really spend a lot of time working with emerging managers, both on the venture capital and private equity side, as well as independent sponsors on the private equity side, to find interesting companies in the US lower middle market that we can partner with and that we can think can generate outsized returns. And I've been with TIF for coming up on 9 years now, working across all aspects of what we do on the private market side.
And after that introduction, I don't know if I have any questions for him, but Justin?
Thanks. So I'm Justin Barton. I'm the Chief Investment Officer at UCLA. Have been on the buy side for pretty much my whole career, so about 20 years as an LP or direct investor at endowments, small fund of funds, and a large listed asset management firm. Spent about a decade exclusively as an emerging and frontier markets investor, so have plenty of scars over that period of time. And I would say what's nice about that, I think a little bit like VC, you're iterating a lot with cycles, so have seen a lot of ups and downs. For the past 6 years I've been CIO at UCLA. We're about a $4.1 billion university endowment, global multi-asset class portfolio.
Great, thank you. Ellen?
Good afternoon, my name is Ellen Ellison. I'm the Chief Investment Officer of a brand new family office for a British family in London called Heiko Ventures. After about 20 years managing 2 US endowments, University of Miami and the University of Illinois Foundation, I decided to do another startup. I think it's my 4th. It's going to be my last because I forgot how hard it was to do a de novo situation. But I am now mostly living in London, and I'm very delighted to be here. This is my first time at March Capital. So
great to have you.
Thank you very much.
Yeah. So we've obviously spent time with each other. We know each other a little bit, some of us better than others. This community is very important for what we do in our world, because they are the ones that make decisions on how they look at where the dollars they manage are deployed, and part of what they do goes into venture capital, which is what we do. So it's always interesting to hear from different entities. So maybe, Justin, the endowment world has been quite active in the world of technology and in the world of investing in privates for a long time. What is it about what you do that people on the outside may not appreciate or may not fully understand? Like, how does an endowment think of capital?
Yeah, I think it's a challenge for us in terms of communicating sometimes to even our stakeholders as to what the purpose of the endowment is. It is a perpetual pool of capital, but really it's supposed to be providing a consistent payout. And so even though we have a very long-term time horizon and can withstand a lot of the volatility that you might see in very high-risk investments, like venture capital, for instance, or even honestly just the S&P 500, we need to be able to continuously pay that money out and provide stability. And so we really need to have a pretty diversified portfolio across multiple asset classes, with each of those asset classes serving a specific purpose, and still generate a relatively high return. It's got to be probably around 5% real. And that is going to ultimately lead you to a pretty significant equity orientation.
Yeah.
So it's balancing.
So an easy job.
Yeah, very simple. Just put it all in the S&P 500 and forget is what some of our people seem to think that we should do. But
I think similar experience. Ellen, you've had experiences in foundations, you've done endowments, now you're doing a family office. Talk to the audience a little bit about how that's changed how you think about where to put capital. And it's a broad question, but in this context, what should people think about that?
I never thought I would leave the endowment world. I really loved working in an investment role for a mission-driven institution. I'm married to an academic, so I feel like I should have gotten a PhD along the way, but I just forgot. I find working for a family, I'm working for a family that has a very similar time horizon as UCLA, in the sense that the goal is to build a multi-generational portfolio. The goal is to ultimately fund a family foundation that is probably going to be set up next year. I think families and endowments have more in common than not today, especially since the families have grown in size and in assets and sophistication. So I feel that endowments and sophisticated families can actually learn a lot from each other. I'm trying to bring the best practices from the endowment side and marry them with some of the things that are great about families. The families tend to be much earlier. If you fail, it's not a public thrashing. You learn from your mistakes and you move on. I like very much investing below the radar.
So every family office is different. We obviously have quite a few of them as investors. Decision-making, historically, where the families come from, how they've created their wealth, how much of that plays into your job?
I think the DNA of the family is hugely important, and I don't think I appreciated this. UCLA and Mount Holyoke College have nothing in common, but the DNA of an endowment program is far more similar than that of Family A and Family B. The family I'm working for is British, but has been in Asia for the last 60 years, 65 years. Great operating background. Very risk-seeking, given their industry background. And so you're building a program that really has to fit with the DNA of the family. And that is definitely more specific and individual to a family than it would be for an endowment program.
And I want to cover a little bit in similar track with both Badr and Stephen. Maybe Stephen, start with you and talk a little bit about what your mission is at TIFF. And I know you focus on the privates, but broadly, how does the organization work and how do you think of that role?
Sure. So our goal at TIFF is a mission-driven organization to pursue investment excellence on behalf of endowed charities. And so our goal is to work with the nonprofits that choose to partner with us in a way that can help them achieve their ultimate goals from an investment return standpoint, sure, but also for their broader goals in terms of how they want to operate their endowments or foundations and how they want to use the capital. Similar to what Justin was saying in terms of having a payout, many of the foundations that we work with are somewhat smaller than the typical university or endowment investment office. I mean, call it in the $200 million to $600 million of investment size, although there's a wide range of both above and below that. And oftentimes they have different needs and different level of reliance on their endowment than a larger institution. And each one of the 500 different endowments that we serve have slightly different preferences. They have their own slightly different decision-making model and their own slightly different goals for their investment. So our mission is to work with them to help them achieve their goals. And the primary way we can do that is by delivering excellent investment returns for them. If they have more money to work with, that is better for everybody in any state of the world. And so that's really what we try to focus on is delivering the best returns that we can. And I spoke about it briefly in the intro, is that one of the ways that we think we can do that is by leveraging illiquidity, and many of the foundations and nonprofits that we work with do not have the level of illiquidity in the portfolio that we think would be appropriate or that many of them can handle given their size. And so a lot of it is, in addition to the investment work that we do, there's also an education component to it as well, of working with the nonprofits that we serve to educate them on the different types of asset classes that they can invest in, what the risk return profiles of those asset classes are, and how adding something like venture capital or private equity can be ultimately beneficial to their overall returns.
Whether you're coming from a very different organization.
Yeah.
It's the people's money, the kingdom's money. And you're one allocation of the top pool. And when you think about the strategic interest that the government or the people have, what role does Senabil play in there? And then how do you think of that then applying to what you do day to day?
So
maybe give people a sort of sense of size of Senabil and your relatively, how much money you have to put out to work.
so we deploy about $2 billion annually, mainly in venture capital and growth. I think on the strategic aspect, the reason Senabil is actually a separate entity from the public investment fund is that we are mainly driven by financial returns. Strategic or developmental mandates is nice to have, but it's not a mandate that we follow or something that we would actively want to engage in. If it makes sense from a business perspective, we would definitely help our portfolio companies in pursuing that. But the main goal is financial return. So maybe that really.
And is there a target return is how you think of it? Or is it just.
Sorry, say that again?
Is it a target return, a threshold?
So, our goal is to generate alpha, right? And that comes from building our portfolio. We're focused on very specific asset classes. So it's not really a well-diversified portfolio because we think of ourselves as an extension portfolio of a larger, so very a specialized kind of investment house. So what we do when it comes to diversification is actually looking at it from an asset class perspective or kind of into the asset class. So looking at venture capital or growth, our goal is to invest in the best managers in each of the different stages that the managers operate in. So from seed, early stage, all the way to growth pre-IPO. We'll map the market, we'll figure out where we want to invest, and then kind of try to break into those GPs and build those relationships to invest in those funds. Similarly, we do that on the direct side. Something we've been, just an example, something we've been doing since earlier last year is, we have a dedicated task force in AI right now that's been, for the first 6 months, mapping just what AI is and what's the tech stack, what's investable, what's not, and also leveraging a lot of the relationships we have in understanding what are the house views in different market participants, and then building our own house view, and then really pursuing that from an investment perspective. I think we're in the first innings of doing that, and investing, have it be an infrastructure that is that we think is going to be supported by AI, or on the app stack, or just different places that we think will make sense. So really, that's how we look at asset allocation when our asset classes are actually limited and focused.
Yeah. And so Justin, how would you think of that question? When you think of last time you and I spoke, you were like, look, it's one endowment, but there's probably 100 endowments within that endowment, each with a slightly different, nuanced, approach at what we can do with it.
Yeah.
And then you have, 18 months ago, a kind of unleashing of and creation of so much wealth, close to $5 trillion of equity value in just 6 stocks have been created because of this focus on AI. How do you decide where to allocate capital? And then we're going to get into where is it, what is it that you've decided,
Yeah, so you have, I guess you could call it structural allocations, your investment policy statement, so the asset classes that you want to be invested in. And then you have some, I guess you could call them tactical things that one might look at. But ultimately we're trying to, within each of our asset classes, if it's private, figure out what is the pacing that we want to have so that we're reasonably diversified across vintages. We're not taking unintended bets within that part of our portfolio. But I think also recognizing so we don't kind of chase our tail. There are going to be sins of omission, and then there's going to be sins of commission. And we don't need to invest in every single great manager that's out there. Frankly, we can't do all the work and diligence needed to capture
fairly
every
small
great
team.
investment.
Yeah.
For a fairly small team, there's 9 of us on the investment team. But we do need to make sure that the investments we do make are well researched and we minimize the sins of commission. From there, we're looking for good partners. We're looking for people who are motivated, good alignments of interest.
But you don't have a process where you can go to your board and say, hey guys, we think this was not part of our thought process, but suddenly we should consider this, and this is very important, we can't ignore it?
We do have quite a bit of flexibility within our investment policy. So what falls within broad asset classes for us, which would be public equity, private equity, venture capital, independent return, which is pretty wide, natural resources and real estate. There's a lot of things
timber.
we can do
You
in
don't
there.
buy timber.
Oh, it could fall in natural resources. So there's a lot of scope for what we could do.
Yeah.
It's up to us to filter that out and then discuss as a team. The investment decisions, the way we're set up, all rest within our organization. So our board is not an approvals board; it's an oversight and reporting board. So all investment decisions rest in our office, and those are determined by what we think of as will they meet the return hurdles that we've set for ourselves, and is it a compelling opportunity?
And so, Ellen, for you, as you basically started building a program from scratch, I remember meeting you when you didn't have a single employee. You were looking for your first sort of someone to come support you as you did this. How do you think about this? And where are you? And again, let's now start focusing on where are you focused?
I think that, how can I put this? I believe that governance for a family is just as important as for an educational endowment or arts endowment, but people don't tend to speak that way. However, if families want to build a truly robust program, they need it just as much as UCLA. So that I have a strategic asset allocation. I'm managing one pool that's very tax favored. And we expect to have a 25% allocation ultimately. It will take a while, market conditions pending to venture and PE combined. I believe in a very open, very flexible asset allocation policy that does not have very many boxes to check because frankly, some of the best investment ideas don't really fit in a box. And you never want to say no to talent with the phrase, I don't know where to put you. So I have global public equities, I have private investments, I have the famous other global diversifying, that's where you put all the stuff you don't know what to do with, and then global sleep at night, surrounded by very wide ranges. And I have been delegated investment authority, which frankly, I think is unusual this early in a relationship because when you work for a family, the trust part of the equation is everything. So I wasn't really expecting to receive the ability to make all investment decisions from my oversight advisory group this early in my tenure, but I'm very happy to have it. I've started building out the venture portfolio. I am a very classical seed stage person. I think venture was the way it was meant to be in the 1970s. And so I really like early stage and seed stage venture. And I've just hired my number 2 from a family office in Chicago who's moving to London, who'll help me build out this program. Right now we have very little, I would say.
So I'm going to ask the same question maybe to Stephen is, when I spoke to you, you said early stage is kind of where you're focused. Now, I've done a lot of early stage and and I've probably got exposure to that and at some point in my life I decided, well, if I invest in something that's too early, I may be too old before I see that money back. Why early stage? Let's talk about that.
Well, for one, I mean, we ultimately get late stage exposure by investing in the early stage. I mean, if these companies are successful, then they will ultimately a seed company will become a Series A company, will become a Series B company. So we end up, if you actually look at our, the net asset value of our venture capital portfolio, it is broadly diversified across stage. We just want to get access at the early stage. And I think, I think if you look at the returns to later stage funds over the past, 12 to 18 months, we looked like, fools for avoiding the late stage, in the kind of 2020 to 2022 period, and we look a lot better now,
yeah, for sure.
Recently for avoiding investing at the late stage. And so there are a couple different reasons that we prefer the early stage. One is we think there's a better opportunity for the investment managers that we partner with, and we're very manager-centric in terms of how we choose to partner with venture capital funds. We think there's a higher possibility or higher ability for these for early stage managers, particularly at the seed and Series A stage, to positively impact companies. I think many venture firms, even at the later stage, will have great operating resources, operating partners. But at some point, the company is sort of on its trajectory and is going to be successful or not, based on the quality of its own people internally. And so we think that the managers that we partner with, we really focus on groups that have some sort of operational or strategic expertise that we think could help these companies at the early stage, marginally increase their odds of being successful. Two, if you look at valuations over time, the seed stage valuations have certainly gone up over time, but they have not fluctuated nearly as much as valuations, at the Series A, B, or later stages. So we think that you get, more bang for your buck, essentially at the early stage than investing at the late stage. And also, we are very, we recognize that venture is a hits-driven business. I mean, the vast majority of the returns in our venture capital portfolio have come from a handful of companies. And so we like having a very broad, diverse portfolio of companies. Many of our early stage managers will invest in, some will invest in 15 or 20 companies, some will invest in 50 to 70 companies. And so we like having, high ownership percentages at the early stage. They will get diluted down over time as they raise more money. But if a $10 billion outcome for an early stage investment, will almost always be successful. And that's not always the case if you're investing in the Tiger Globals of the world that are, investing, the Series F stage.
Interesting. So help me understand, when you guys think of partnering with a manager, how do you make that decision? Like, what inspires you to choose a manager?
Well, as Justin said, there's we can't invest in every great manager that we meet. We have a team of 8 people that are focused on private markets, and that's venture capital and private equity. I think venture capital is a lot harder than private equity investing, and so we really focus on high degree of alignment, high degree of integrity with our underlying partners, and we really try and focus on people who we think have some sort of edge in terms of finding new companies. So that can be their network, that can be sort of sheer hustle, it can be their prior work experience.
Just buy a ticket to the summit and come.
Exactly, yeah, exactly. So, groups that have some sort of edge in finding new companies and, or preferably some level of edge in helping these companies be successful. So some sort of operating experience, work at a larger corporate, work at a startup. There's no clear, path to becoming a successful
But is it like a top-down filter? Is it a geographic filter? Like, how do you think? Are you just opportunistic?
We are very opportunistic. Our mandate within our private portfolio, again, this is venture capital and private equity, is to beat the MSCI World Index by 5 basis points on a consistent basis. And we've done that throughout the course of our history of investing in private markets. And so we can invest in anything that we want to that we think will help us achieve that goal. And we think that lower middle market private equity and early stage venture capital are the best ways for us to do that. And so we are very opportunistic in terms of where we invest and how we invest. And frankly, over the past few years, we've, after having a more globally diversified portfolio, we've really been focused over the last few years on the U.S. And we think there are great opportunities. There are new innovative companies that are going to be there. There are a ton of lower middle market buyout companies in the U.S. That or buyout opportunities that we think are quite interesting. And also, it's an area, to Justin's point that he was making earlier about sort of the ability to diligence these companies. We just know the U.S. market a little bit better, and so we feel more confident in our ability to pick high-quality managers that are going to invest in high-quality companies in the U.S. than we can if we're investing in markets that we don't know as well.
And so, brothers sitting half around the world, how do you find good managers? They find you?
So I think our partnership with our managers is literally the cornerstone of our strategy. When we started our venture program, I think the biggest question we were asking ourselves is, how would we get a high-quality pipeline of opportunities to invest in? Sitting halfway across the world, you're not going to see the best deals. You're not going to see the best managers. You're not going to see the best companies. So how do you kind of get around that? And one of the things that we've built is, from the get-go, as we build relationships with managers, we upfront tell them that we have a dedicated direct team. We want to work together. We're not your typical LP who sits there waiting for a capital call to send the money. We're a very active LP. We're willing to engage. We're willing to share ideas, and then we act on it. So we understand these relationships are not built over a couple of calls or by building a relationship with the main two partners. It's actually building a relationship with the partners, with the principals, with the working team. And as you build that trust, you start seeing that pipeline coming through. I think also on the other side, I'm going to maybe focus on how do we source to the direct side, right? Because that's really my focus in the company. There is a certain profile of funds that actually fit into that bucket. I'd say it's a multi-stage fund, probably $200 to $500 million fund size, and is operating between the Series A and maybe Series C, D. And why do we like these managers? Well, we think that that's a good fit on this integration is that typically whatever deals they see, the bite that would be available would be much larger than what they can accommodate in their fund. So they actually will be incentivized to partner with someone who can actually provide the firepower, but they also can provide, I'd say, be as nimble and can talk the same language in building conviction, and sometimes actually share due diligence notes between each other and actually come up with a better assessment of the opportunity. And we've done that with March. We've done that with other fund managers. We've co-led deals. We've co-underwritten. We've followed on into companies where we were introduced to, at least the first call came through an introduction from a fund manager. And it makes a huge difference. It's not a cold call. It's a warm call. And that's something that, is something that...
For the audience's benefit, this is public knowledge, so I'm not saying something that's not. Their problem is a little different. They have a lot of money to deploy. And even though he's saying $2 billion a year, the pool of capital now, it's a Nabil is what, 130 billion?
Sanabris Capital? Well, it's not disclosed, but yeah. You can
It's in
guess.
the Wall Street Journal. You guys,
It is
they
now.
were just gifted 4% of Aramco by the government.
Yeah, that's public knowledge, yeah.
So that's 80 billion, you know,
Yeah, exactly. Yeah.
approximately, with $4 billion of dividend every year. So, you know, it's a different problem, Justin.
Yeah,
So,
I mean, I was
And
listening.
so the reason I bring it up is I think allocation also comes from what your intent is, like what's driving your decisions, right? And in each case, I think it's slightly different, but go ahead.
Yeah, that's exactly what I was thinking as I was listening about our talking is, you know, you set up your strategy for what works for your pool of capital.
Desired outcome.
And what is, you know, what makes sense. So, you know, listening to you say we're deploying about $2 billion a year, you know, we're committing about $70 million a year. So the opportunity sets are just vastly different. Returns are important, but actual total P&L is important too.
Yeah.
And so for us, you know, we try and shape our venture portfolio, for instance, to what makes sense for our
That
pool
size,
of capital.
yeah.
And that would tend to lead ourselves to, you know, smaller funds
Right.
where, you know, it's easier to make a big multiple on a smaller pool of capital than it is in a large, but we don't need to move the needle as much for our pool.
No,
So
I think
those
I totally agree, and I think the other aspect of this on the other side is that when you're deploying $2 billion, you cannot ignore the, you know, $2, $3, $4, $5 billion size funds saying, you know, they're just too big because, you know, if you're going to deploy $2 billion, you need to invest in growth funds and large funds, and but then comes then manager selection becomes even more important.
Yeah. Interesting. All right, so we're moving to a slightly different topic. If you were thinking about where we are in the world today, and context being, like, say, 15 years ago, everyone wanted China exposure, you know, and then there was this whole ESG move, and everyone was starting an ESG fund, or at least talking about it, if not starting it. What's the flavor of the moment? Like, Ellen, maybe I'll start with you. Like, what do you think you have to have exposure to, or is there none?
Well, the flavor is so obviously AI. So when you're starting with a blank sheet and no legacy, it's liberating and also a bit intimidating. I would like very much to have Chinese exposure because I have none, but most US institutions are chock-a-block with a lot of Chinese, both private and public exposure, so that I would pursue some probably public equities in China. I don't have any political or university-driven restrictions relative to where the money goes. Also, the company that is the source of the money I'm managing has significant operations in China in the shipping business. So I would invest in China now. I look at relative, I tried, when you're starting from nothing, I just started with relative valuations, where in the world were things relatively cheaper, and that was not in the US, but you know, now, 2 years into this corrective cycle in VC, and to a lesser extent, lower middle market PE, this seems like a reasonably good time to be deploying fresh capital into the market. So I'm just fortunate to be starting with cash versus having big positions built up. As someone said earlier, I looked foolish when I didn't have them, but now that I don't have them, I don't look so foolish.
It's very cyclical. All of
Yeah,
these things
so it's nice to start when it's more of a tailwind instead of a headwind. So I think this is a great time to allocate capital to venture over the next 3-4 years. And also ESG is a pretty fully integrated part of my process in terms of looking for certainly avoiding risk. It is a risk factor, and also looking at climate transition and client energy transition solutions. So I've invested in that in both the public and private side of the book. But you know, it's your starting point. You don't get to necessarily choose it, and so I think my job is much easier than Bender's because I don't need to allocate $2 billion to venture every year. I wouldn't know how to do it. I like funds that are 100 to 300 million maximum. on the venture side, and I've gone even smaller than that.
So unfortunately, Badr has to be on a plane to come to the US at least, what, 6-9 times a year or something like that?
Yeah, sometimes, yeah.
You should be used to jet lag by now.
I am.
Justin, what's your reaction to this, and how do you guys think of it?
So as a steward of permanent capital, we tend not to want to make short-term views, and so we tend to be very structural. But I think if there's anything that's a thematic investment that we have made and continue to believe strongly in over the next decade plus, and it was something that was discussed earlier today in some of your panels, it's in healthcare and particularly biotechnology.
Yeah.
And so for us, sitting at UCLA with a pretty large health system as well, that kind of informs our decision making. But it's looking at the decline in costs for sequencing the human genome. It's looking at AI empowerment. It's looking at, in the US, 20% of GDP. And it's looking at just the human desire for longevity. And you see kind of all of those things coming together. And so that's, across our portfolio, we've made a concerted effort. Biotechnology is about 10% of our public equity portfolio. We have venture capital investments in that space. We have real estate investments linked to health and life science. We have private equity healthcare investments. So healthcare has been a big area for us, and I think will continue to be.
Okay. Maybe slightly different question for you, Stephen. You have a group of VCs. They want to raise their next fund. They find time on your calendar. What's the biggest misconception people have when they come see you and you wish they had known before you met them?
It's a very good question. I mean, we always make time for our existing partners. I mean, maintaining and managing our existing relationships is, I think, a core part of any, the role of any institutional investor. Not only for continuing to invest in funds and partners that we know well, but also, many times these are sources of new relationships as well. Not every venture capitalist stays at the same venture capital firm for their entire career, and so, getting to know people broadly across the team is very important for us to, one, know who's actually making decisions, who's doing deals, and who's really driving the needle, but also so that if someone does decide to leave, we can be there, because we want to back emerging managers, we want to back Fund 1 and Fund 2s. So maintaining those relationships with our existing partners is always core for us. I think the other thing for us is we have a sort of we have a very broad mandate, but kind of a pretty tight lens that we view the world in. And if there's a manager that is investing primarily in Series B or C, they could be the best manager in the world, but that's not really something that we're going to spend a whole lot of time on, because even if they're a great manager, that's just sort of outside our target area, and we don't want to waste their time or our time. And so for us, we have kind of some pretty sort of high-level screens that we do. Are they focused on the early stage venture capital in the US, Europe, or to a lesser extent, China or Southeast Asia? Or is it a relatively small team that's managing less than fund sizes of less than $300 million, preferably $150 million or less? Are they generally we don't have anything sort of against life sciences or biotech, but that's not really nobody on our team is all that specialized in life sciences or biotech. So we will invest there, but it takes us a while to get comfortable with that. Mm-hmm. And so it's kind of easier for us to move more quickly on things like enterprise software or consumer internet, or businesses like that. So we, I think as if for a venture capitalist that's looking to raise money, just understanding what the parameters of whoever you're pitching to or whoever you're talking to, of what they're looking for, is, I think, quite important, because, again, even though we have a very broad mandate, we have a pretty specific lens that we view the world, where we think we can find the best opportunities. And also, quite frankly, this is something that Beta brought up, and Justin as well, is that we want to leverage our unique strengths in terms of how we invest. Investing in smaller funds, investing in emerging managers, and leveraging our, the nonprofits that we work with, many managers want to invest on behalf of nonprofit institutions. Yeah. And so how can we leverage our core strengths to generate the best returns that we can? And so we kind of view the world in that lens, and we try and prioritize our time and efforts to focus on that. And that can be very hard for someone who's like not working with us on a day-to-day basis to do that. We don't really post that on our website anywhere, but oftentimes, when we pass on meeting with something, it's not because we don't think the manager is interesting or we don't think it's necessarily a good opportunity. It's just not the right opportunity for us.
So, Ellen, if I have to ask you a question, we're on, getting to the last few minutes of the panel, to say, I want someone in the audience, I'm looking for this, and if there's someone in the audience who fits that, come see me, what would that be?
I'm sorry, what was the first part of the question?
I am looking for this strategy, some strategy, whatever that is. I'm looking for some partner to work with, whether it's investing in certain type of assets, or whether it's a certain type of, and if there's someone in the audience that wants to come talk to you, they should. And on the flip side, don't come talk to me if you do this.
Oh, that's a hard question.
You want to give it to someone else?
It's a very easy question for me to answer.
Go ahead. Give Ellen time to think.
It kind of fits into, Stephen, what you were asked. So I think what people don't realize is, so yes, I'm ultimately making the final decision. I hire a really good team, and they are motivated to find managers. You should go speak to them. Don't come to me. Because I trust my team to make good decisions. I'm not going to force things down on them. Yeah. So you should build a relationship with the people in my organization. Don't come to me.
So please don't approach him. He doesn't talk to anyone.
I think I've been thinking a lot about as strong as the U.S. has so many strengths that I didn't appreciate until I moved to Europe. But I think certainly fund specialization is really important, which is the case with March Capital. I'm embracing the fact that it is a big world out there, and I've started to do more work on EMEA venture. The European venture scene is very, very difficult for reasons that make sense, much more capital constrained and much more conservative, so that lower highs and much higher lows through the last cycle. But the comments that Mr. Milcom made this morning about Israel really resonated with me, because Israel really, hits way above its size and weight in terms of innovation and in venture. So I'm interested in building out a global portfolio in seed stage venture Series A, but one that will probably be maybe 2/3 US, 1/3 non-US. So if someone on the non-US side would like to talk to me, that would be great.
There we go. Father, what about you?
So I agree with talk to the team, definitely.
I thought that was my line, by the way. I use that all the time with entrepreneurs.
So I think, to me, I think we're all human beings and we're always biased, right? So a warm intro will definitely be a much more impactful kind of reach out than a kind of a cold email that comes through, right? Probably get between 50 to 200 emails a day, depending on the day, right? And I definitely will read the email. I'll screen it. I understand my strategy. If it fits, I'll probably reply. If it doesn't, I just do not have the resources or time to reply to every single email. But a warm intro, I will always, cherish the relationship that I have with that person, and will always reply, regardless if it's a yes or no. I think something that to me personally, and I think something that our team really holds greatly, is that whenever we engage with anyone, we always promise if it's a no, it's going to be a quick no. We don't want to waste anyone's time, and we're not going to drag this conversation. We don't see anything that actually would work from our side. So that's something that we always kind of try to do.
Sunabel is part of a group of companies in Saudi, host a conference every year, and I'm amazed at the number of globally recognized financial institutions that gather there every year?
I mean, there's a reason.
Of course there is.
If
No,
you-
that's
if
where
you
the
don't
money
know,
is.
Go visit and see it for yourself. I mean,
Yeah, it's
the amount
unbelievable.
of energy there is. I was just maybe one comment. The last thing you said, where would you invest? I think today, I'd say definitely the U.S., just given the size of the economy, specifically in AI and healthcare, because it's focused sectors of the U.S. Outside the U.S., I think the two markets I am very excited about, maybe I'm biased, I think I am biased, but I think India and Saudi Arabia right now are like beacons in the global economy. From GDP growth, from opportunity, from the energy that you're seeing coming out of these two countries. That's also a big focus for us.
Yeah, geographically things have shifted. We have a few seconds, almost out of time. Does anyone want to say something we haven't covered?
Well, I will just say in answer to your last question, we are always looking for new early stage venture capital managers and new low middle market buyout managers. And I think we take a very broad view of what entrepreneurship means. I think entrepreneurship is much more broadly defined than a venture-backed startup. I mean, there are many family and founder-owned businesses in the U.S. that are fit the definition of entrepreneurs, and we're very interested in backing those. Just from a personal interest, I cover our relatively small venture capital portfolio in China at the moment, and we're looking for new opportunities that are outside of China, whether that's Southeast Asia, Japan, Korea. So I think those are areas of interest. Then I'll also sort of give a quick plug for our organization and say, many people in this room probably either work with or know people who are involved with nonprofits or work with endowments or foundations that are relatively small. Many of them, not all of them, but many of them could use some professional help, and they're not always well-resourced with professional staff members to do that internally. So if you do happen to know anybody who you think, who a nonprofit, an endowment, a foundation, a charity, a secondary school, a family foundation, anything like that you think could use some professional advice, please send them our way.
All right, with that, thank you very much. Thanks for coming to see us, and we appreciate you giving us your time and
Thank you
insights.
very much.
Thank you.